What's the real difference between a bull and a bear market? And how do these trends actually impact the economy? To understand this, let's start with the basics. A bull market is often associated with a thriving economy, where stocks are rising and investor confidence is high. It's like a snowball rolling downhill, gaining size and speed as more and more people jump on board. On the other hand, a bear market is characterized by a decline in stock prices and a general sense of pessimism among investors. Imagine a big wave receding from the shore, pulling everything back with it. The key to understanding the difference between these two markets lies in the mechanisms that drive them. The first mechanism is investor sentiment. When investors are optimistic, they're more likely to buy, which drives prices up and vice versa. The second mechanism is economic indicators, things like GDP, inflation, and employment rates. And here's the surprising part. These mechanisms are interconnected, and they can create a self-reinforcing cycle. As we explore the real difference between bull and bear markets, we'll dive deeper into these mechanisms and how they impact the economy. By the end of this, you'll have a clear understanding of what drives these trends and how they affect the market. Vocabulary, sentiment, mechanisms, indicators, trends. What happens when investors start to feel optimistic about the future of the economy and stocks begin to rise consistently? Is this just a temporary trend, or is there something more substantial at play? Let's break it down. A bull market is like a rising tide that lifts all boats, where the overall sentiment is positive and stocks are consistently increasing in value. Think of it like a big wave of confidence that carries most investments upwards, making it a good time for people to invest. And here's the part that's key. This isn't just about feelings or hunches. Bull markets are often driven by strong economic indicators, like low unemployment and GDP growth. For example, when unemployment is low, people have more money to spend, and businesses tend to do well, which in turn drives up stock prices. It's a self-reinforcing cycle, where good news begets more good news, and investors become even more confident. The third aspect that surprises everyone is how broad this effect can be. In a bull market, even weaker companies can see their stock prices rise, simply because the overall trend is upwards. So, understanding bull markets is about recognizing these underlying drivers and how they create an environment where investments are more likely to grow. Now, let's take this understanding and see how it compares to the opposite scenario, the bear market. Vocabulary, confidence, sentiment, unemployment, GDP. And here's the surprising part. The opposite of a bull market is called a bear market. But instead of smooth sailing and rising prices, think of a stormy sea where everything seems uncertain and people are understandably cautious. Now, imagine you're out on that rough ocean. The waves are high, the sky is dark, and it's raining heavily. This isn't the time to go for a swim. That's right, this is more like a bear market environment. In a bull market, everything feels good. Stocks are rising like tides coming in. But in a bear market, stock prices are falling like those heavy raindrops hitting your windshield. It's not just about one or two stocks either. It's the overall sentiment and price of most stocks that are dropping. What causes this stormy weather? Well, there could be many factors. Economic downturns are like a cold front moving in. Everyone's feeling gloomy and prices start to drop. Geopolitical tensions are like sudden squalls, unexpected events that can send markets into turmoil. High inflation is like the tide rising, but harder to predict exactly when it will peak. Investors become very cautious during these times. They're not sure if they should buy or sell, much like you wouldn't jump into those choppy waters without a life jacket. This makes investing more challenging as fewer people are willing to put their money on the table. And here's another surprising part. People often confuse bear markets with crashing economies, but that's not always the case. A bear market can occur even when the economy isn't in an official recession. It's just a period where investor sentiment turns negative and stocks trend downward. So, while bull markets are like smooth sailing, bear markets are those stormy seas you want to avoid unless you're fully prepared. The key is to stay informed, be patient, and remember that every market cycle has its ups and downs. Understanding both will help you navigate through them all. What exactly sets a bull market apart from a bear market? And how do we know when we're in one or the other? The answer lies in a set of key indicators and mechanisms that drive these markets. Think of it like a weather forecast. Just as meteorologists use certain signs like cloud patterns and temperature to predict the weather, investors use specific indicators to determine the state of the market. One of the most important indicators is the 20% threshold. If the market falls by 20% or more from its peak, it's considered a bear market. And conversely, if it rises by 20% or more from its trough, it's a bull market. And here's the surprising part. Market sentiment plays a huge role in driving these trends. When investors are optimistic and confident, they're more likely to buy, which drives prices up and fuels a bull market. On the other hand, when they're pessimistic and fearful, they're more likely to sell, which drives prices down and contributes to a bear market. Economic policies, such as interest rates, can also influence these trends. For example, when interest rates are low, borrowing money is cheaper, which can stimulate economic growth and contribute to a bull market. Understanding these indicators and mechanisms is crucial to grasping the difference between bull and bear markets. By recognizing these signs, investors can make more informed decisions and navigate the markets with confidence. And that's what we'll explore further in the next part: how these mechanisms interact and impact the market. Vocabulary, sentiment, threshold, mechanisms, indicators, trends. What if I told you that bull and bear markets aren't always two separate entities, but can actually coexist in the same economy, just like two different weather systems can exist in different parts of the world? This is because different sectors or assets can have their own unique market trends, independent of the overall market direction. Think of it like a big portfolio with many different stocks. Some might be doing well, while others are struggling. And here's the surprising part. Understanding this interplay between bull and bear markets can provide valuable insights into the overall health and direction of the economy. For example, during an overall bull market, there can still be bearish trends in specific sectors, such as a decline in the automotive industry, while the tech sector is booming. This nuanced view can help investors and economists alike to better navigate the complex landscape of the market. By recognizing that bull and bear markets can coexist, we can gain a deeper understanding of the underlying forces driving the economy and make more informed decisions. And that's what we'll explore further in our final scene, where we'll dive into the practical implications of this interplay. Vocabulary, portfolio, trends, sectors, assets, economy. So, what's the real difference between a bull and a bear market, and why does it matter? In essence, it all comes down to understanding the underlying mechanisms that drive market trends. A bull market is like a rising tide, where investor confidence and demand for stocks are high, causing prices to rise. On the other hand, a bear market is like a receding tide, where investor sentiment turns pessimistic, leading to a decline in stock prices. The interplay between these two forces is what shapes the economy and financial markets. By recognizing the indicators and mechanisms that drive these trends, such as economic indicators, market sentiment, and geopolitical events, you'll be better equipped to navigate the complex world of finance. The third key factor is understanding how these trends impact different asset classes, from stocks to bonds, and even cryptocurrencies. And here's the surprising part. Once you grasp the difference between bull and bear markets, you'll start to see the underlying forces that shape the economy and financial markets in a whole new light. In conclusion, understanding the difference between bull and bear markets is crucial for making sense of the complex world of finance. If you'll never look at market trends the same way again, and you want to stay ahead of the curve with in-depth explanations of market mechanisms, be sure to subscribe to our channel for more insightful videos. Vocabulary, confidence, sentiment, mechanisms, trends, indicators.